Well, good afternoon, everyone. It is my pleasure to be here. I was here a few years ago. Let's turn. Is that better? Okay. I was here a few years ago during a special session, so, but I do come from a chamber background, and I enjoyed chamber work very much, and so I appreciate what you as local business owners and community folks do for your local community. So I understand and appreciate what you do. So the Alaska Oil and Gas Association is a business trade association that represents the majority of oil and gas companies in Alaska. We represent the major producers such as BP, thank you Team BP, and ExxonMobil. We represent companies in Cook Inlet such as Marathon. Chevron is now actually a North Slope company that you see there. Apache is a new member in the Cook Inlet looking for oil. And we represent the 3 state refineries. There's 3 refineries in Alaska: Tesoro on the Kenai Peninsula, Flint Hills in North Pole, and Petrostar has a... I'm sorry about that feedback.
I think it's Brad's mic. So.
Let's see.
Can we move yours down, Brad?
Obviously, we didn't have a test run through the equipment. There, is that better? And so Petrostar has a refinery in North Pole. They also have a small refinery that makes jet fuel and diesel in Valdez. We represent some new companies to Alaska, but they are not small by any stretch of the means. Statoil and Shell are looking to develop the offshore. Keep moving that down. Eni Petroleum is the one with the tiger. They're an Italian-based company, and Pioneer are both 2 companies that are the newest operators on the North Slope. And we're going to talk more about Pioneer and Eni as we get going. And then, of course, last but certainly not least is Alyeska Pipeline Service Company that runs the pipeline. And I noticed that I forgot to mention Repsol. They're right in the middle. They are a Spanish company that are looking to explore both onshore and offshore here in Alaska. So it's no secret that oil and gas has been good for the state. Since statehood, the state has collected over $160 billion from oil and gas royalties and taxes, and 98% of the state's of all state revenues have come from natural resources. Most of it's oil and gas, but of course Jan's here, so mining and we became a state on natural resources, and it still very much holds true. Last year we continued to dominate the unrestricted revenue stream. That's where you fund your schools, your roads, the general fund, or commonly referred to as the GF in Juneau terms. That was 92% of the state's revenue at $7 billion. And that, of course, is broke out by production taxes, royalties, corporate income taxes, and property taxes. And the state is continuing to forecast that oil and gas will continue to dominate the revenue stream regardless of declining production. We recently conducted an economic study that you can find on our website, which is www.ayoga.org. And this was the 3rd study that we have done over the last 9 years. And what we wanted to do is we wanted to really get a sense of how many oil and gas jobs are in the state. And we surveyed our member companies as well as their service contractors to find out not only where the jobs were, but where those people lived. So we actually asked for their job data by zip code so that we could break out the effects of oil and gas in Anchorage, Fairbanks, Matsu, Valdez, Kenai, and the rest of the North Slope. So altogether, there are about 45,000 oil and gas jobs statewide that generate an annual payroll of $2.6 billion. It's interesting to note that state revenue in FY 2010 was $6.2 billion because the study in 2011 used 2010 data. So you can see that revenue continues to grow from oil and gas. And we just wanted to point out that since the foundation of the permanent fund, since 1982, the Alaska Permanent Fund has distributed $18 billion in dividends to Alaskans. And if you are a family of 4 that have received a dividend every year since 1982, any guess of how much you could have stocked away in your IRA by now? It's over $120,000. So, but when you take a look at that's just the state direct jobs. That does not, our study did not include estimates of the number of jobs that are created from oil and gas revenues to state government. So Scott Goldsmith, who is a professor at the University of Alaska Anchorage at ICER, has done lots of studies over the last 3 or 4 years, and he has been able to tie 1/3 of all Alaskan jobs to oil and gas. So because of oil and gas, it creates a state job, which creates other jobs in the state. So it's about 1/3 the petroleum sector, 1/3 the federal government, and 1/3 everybody else. So I think you saw some publications from some banks a few years ago talking about the 3-legged stool, and this is what they were referring to. So the good news is, I'm an optimistic person, so I'm going to start with the good news. The good news is Alaska, even though we've been safely developing oil and gas resources for over 30 years, we are still rich in resources. We have produced over 17 billion barrels of oil and gas from Alaska's resources, most of it, of course, from the North Slope. The Cook Inlet still believes about 600 million barrels of oil and 19 TCF of gas. Onshore North Slope and the conventional resources, that means what's known, like Prudhoe Bay, Kaparik, the existing fields, we still believe there's 5 billion barrels of oil there, and 35 TCF of gas. Of course, looking to the future, 10, 15, 20 years out, there is a significant amount of heavy and viscous oil that could be anywhere from 24 to 32 billion barrels of oil. And then unconventional, such as shale, is about 2 billion barrels. But when you look at the other side of the chart and you look at federal land, and like I said, we have companies who are really hoping that they are able to drill this summer their first exploration well since the 80s. And you can see why. You can see why that they have stayed at it for over 4 years. They got their leases over 4 years ago, have spent over $4 billion, and have not been able to punch one exploration hole yet. But why do they keep at it? Because we think there's 27 billion barrels of oil in the Arctic offshore. It really could be the next generation of oil and gas development for Alaska. So remember, 17 billion barrels to date over the last 35 years. We think the offshore might have 27 billion barrels. So you can see why Shell and Statoil and a few others are been so diligent about trying to get out and explore. The Natural Petroleum Reserve has just under a billion barrels of oil, and of course I would be remiss if I did not mention ANWR, even though politically that seems to be off the table, although there are some in Congress, thank you Congressman Young, for continuing to push the development of ANWR, because conservative estimates, it's 10 billion barrels. And when you take a map of Alaska and you see how far from the infrastructure the Chukchi and Beaufort Sea is, they're going to have to invest a lot of money, and even if those exploration wells are successful in the Arctic offshore, you're looking at 12 to 15 years before you would see one drop in our Trans-Alaska pipeline. So, but when you look at ANWR, much closer to infrastructure, and there's 10 billion barrels away, or billion barrels of oil, and much closer to infrastructure. So we do appreciate the ongoing efforts by many in Alaska to continue to support ANWR. But the real problem is production decline. And I hope it's no secret to any of you in the room that the pipeline is now operating at 1/3 less its original capacity. Production is hovering at about 600,000 barrels per day. Peak production was 2 million barrels, and this is our forecast. So as you look at this slide, and this comes from the Department of Revenue, this is not our forecast, this is the state's forecast using oil and gas company data. The blue line, and the graph starts in 2008 when we were at 700,000 barrels per day. We're now just 4 years later at 600,000. That shows you from our currently producing fields, Prudhoe, Caparic, and this is North Slope production. The red slice shows you projects that are under development. They might be sanctioned, they might not be, they're not producing yet, they could be close to production, and the green slice are those projects that are under evaluation and they're still trying to pencil them out in the boardrooms. But you can see the blue slice continues to go down. And if you just look 5 years out, in 2016, the Department of Revenue is forecasting that we will need to maintain the top line, all together where it kind of continues to hover around 600,000 barrels per day, we're going to need 180,000 new barrels of oil per day. I'm not sure where that's going to come from when our new fields that I'll talk about are only generating 10 to 15 and at peak 20,000 barrels per day. So production decline is real and it does have serious consequences. So our tax structure. Obviously those of you in Juneau know that is the topic of conversation, just a few blocks up the street. How bad is it really? Steve Forbes was in Anchorage a couple weeks ago, and this is his quote about Alaska. We did not pay him to say this quote. We had no idea he was going to say this, but he said our state has about the worst energy tax policy he has seen anywhere in the world. And we do in fact have the worst tax rates in North America. These are the effective tax rates. This is at the end of the day, when you roll it all together, this is the tax rate that the oil and gas companies pay in Alaska at about $100 per barrel. This is combined. This is federal, state, all combined. Their effective tax rate is 82%. Alberta, which is a very main competitor for Alaska for the companies that we have here, 55%, and the Gulf of Mexico is 43%. This slide I know is busy and shows you a lot, but it shows the effective tax rate at $115 per barrel. The price of oil yesterday was $117, so gives you a really good example of where we are. Alaska is the fourth from the left, or from the right, and we're at right around 75, 76% effective tax rate, and you'll see the Gulf of Mexico is there about 42. Teck, North Dakota, which is booming right now. North Dakota just surpassed 500,000 barrels per day. It is very easy to expect that they're going to surpass Alaska in production by the end of this year, maybe next year. Their effective tax rate at $115 per barrel is just under 55%. And this just shows you what our effective tax rate does at different prices. So about that development, you will hear people say, well, we have one of the most exciting exploration seasons in front of us because of the Alaska Clear and Equitable Share tax structure, otherwise known as ACES for our production taxes. And that is true, I won't lie. Repsol is here because they see an attractive environment for exploration. But they will also tell you, and my board member from Repsol has told me, that the number one thing they're worried about is production taxes. Because development in Alaska is very time consuming and very expensive. Here are the most recent projects. Nikaitchuq is the most recent field that has come online. That is from Eni Petroleum. Their max, they're producing about 8,000 barrels per day right now. Their max production is going to be 25,000 barrels per day. They discovered Nikaitchuq and sanctioned that project under ELF. The taxes have changed 3 times since then, and they just got their first oil last year. So, 7 years. Ugarik, the Pioneer field, similar production statistics. They came online in about 5 years. That is light speed for the North Slope. So you can see that development really does take time. And speaking of Ugarik, there is a picture. It is an offshore, it's not very far, it's in state waters. but it is an offshore island, and it took Pioneer, they had to drill 11 exploration wells before they found enough to bring Ugruk online. So 11 exploration wells just to get Ugruk. So just because we're going to have more wells drilled here than we've had in a long time, 2 years ago we had 1 exploration well drilled. It does not guarantee production. We're excited and we're wishing them all the best of luck, but it just doesn't guarantee production. So what does Alaska's future look like without oil and gas? And as Sheldon mentioned, I came here as a school teacher. I've devoted 15 years of my life to the state of Alaska. I'm married to an Alaska Airlines pilot who will never leave here because he likes to hunt and fish. My kids love it here. I have 3 5.74s, and I'm very proud of that. But Scott Goldsmith has done some forecasting that without oil and gas, with declining production, and if our oil price dropped, if our oil prices went down to 70, 80 barrels per day, and if state spending stayed even at the conservative estimate that Governor Parnell is trying to keep at 2 to 4% annual growth, that's basically just kind of keeping the lights on. The CBR, which has 12 billion barrels or $12 billion in it, will be depleted by 2017. So it is a very grim future without oil and gas. And where would Alaska get its revenue? I mentioned that in fiscal year 2011, oil and gas contributed 92% of the state's unrestricted general fund. Where did it come from? So I figured I'm in Southeast. What industries do you have? Obviously, excise taxes, that's everybody in Alaska. That was 2% of the unrestricted revenue. Corporate income taxes other than petroleum corporate income taxes was 2%. Fishing was at the bottom, mining taxes, and license and permits. So it may seem like oil and gas doesn't affect Southeast Alaska because you don't see it, you don't have many people that probably travel back and forth to the North Slope for work, but oil and gas touches every part of Alaska. So what needs to happen? Well, we agree with Governor Parnell that Alaska's oil tax structure must change, and it must change in a meaningful way. His legislation last year, House Bill 110, would have changed the most onerous part of the production tax, and that's the windfall portion or progressivity, where we pay extra on the price as the price of oil goes up. And unlike our income taxes that we're all struggling trying to file right now, if you go up to that next income tax bracket by $10, you only pay an extra tax on that $10. With Alaska's production tax, our windfall portion, it goes all the way back to $0. So what Governor Parnell is trying to do in House Bill 110, and we agree wholeheartedly, is just creating brackets that are similar to income tax brackets, so that as the price of oil goes up, you only pay an additional tax on that increment. That would be meaningful change. He has also tried to extend the small producer tax credit for our smaller guys who are trying to be here, to be profitable here. That is another major component of his bill. There's several little pieces that I can get into the details on. But one of the most, we're encouraged, House Bill 110 passed the House last year and is still sitting in Senate Labor and Commerce, which is Senator Egan's committee. And they've all said, for politics, House Bill 110 isn't going to be the vehicle. Fine. But we, as the Senate, want to try and work on the oil tax structure. Great. Well, the Senate Resources Committee introduced their bill yesterday. It was read across the floor. And all it does is increase taxes. And I am hoping, and they have said, that this is just a starting point. And so I haven't had a chance to talk to folks on the Hill. I'm headed up there after the speech today. But I'm hopeful that we can really have a good conversation about meaningful reform, because to raise taxes as the starting point does not send a good signal to us, but we are still willing to have the conversation. if this legislation holds, or if they try to just do a minor tweak here or there, industry is likely to oppose that, because that doesn't get us anywhere, and that will not change my member companies' investment decisions. So, reforming oil taxes is Governor Parnell's #1 priority. There are some sign-in sheets around if you want more information throughout the session as hearings are scheduled. House Bill 110 never got 1 minute, did not get 1 minute of public testimony on the Senate. We're hopeful that the Senate piece of legislation does, and that's where we will need your help, to contact your legislator to let them know this is important to you too. And with that, I'm happy to take questions, because when we work together, we win together. So thank you very much. Brad.
According to Bloomberg this morning, Alaska crude is trading at over $118 a barrel. Brent North Sea crude is trading over $118 a barrel. West Texas Sweet and Cushing, Oklahoma is trading at $100 a barrel. And coming out of North Dakota, it's at $73 a barrel. Can you explain why oil prices are so radically different? And should Alaska consider the price in Oklahoma or North Dakota at $73 a barrel in our tax structure?
Well, I didn't realize the inversion had gotten so big. I knew normally West Texas has always been higher than North Slope crude, and I will admit I am not an oil price expert. But there are some reasons for that because of where we supply. It really is it's based on the market, and I will tell you I'm not a market expert. But I do think, to your second question, Brad, should we be looking at what our tax structure is at $70, $80 a barrel? I think that there are those who will say oil prices are going to stay high. They're not sure they're going to stay this high forever. And there are some of our companies, when they make their business decisions, that they're looking at more conservative estimates of price forecasts in the $70 to $90 range. So I think you don't want to set policy. I think the important part is you don't want to set policy just on $100 a barrel oil or $120 barrel oil. You want a policy that can be flexible and balanced for industry and the state regardless of the price. Mindy.
Kara, can you touch a little bit on the Gleason decision?
I am not a Gleason expert, and the Gleason decision is something that is still actually being adjudicated in court, but it does talk about production levels and how low you can go for the pipeline to operate safely. And my response to that is why are we even asking that question? Why are we talking about how low we can go? Because what would our economy be like at $115 a barrel times 100,000 barrels of oil, regardless if the pipeline could operate safely or not? We would not have an economy here in Alaska. It would be a much different state. So I think the better question is how we can get more oil into the pipe versus how low we can go.
I just want to make sure that I'm clear as to what your message is relative to contacting members of the legislature, specifically related to the Senate version of HB 110. Is it still your goal or your hope that Labor and Congress and Senate will hear that bill, or have they told you that it's not going to be heard?
That's a good question. The Senate has told us, the Senate President, now the Senate President told our board, I have not had a conversation with Senator Egan, but the Senate President told our board a couple weeks ago when we were here that House Bill 110 is not going to be the vehicle. So, you know, maybe, I'm not sure it would be worth, you know, urging Senator Egan to move that bill out. It'd be helpful because at least that could be moving. The important point is we need meaningful components like what's in 110 to be in whatever passes the Senate. That's the message, that we need tax measures that and reform measures that are in 110 that will do the same thing that 110 will do regardless of the bill number. We do have a website. We will have a very active Facebook and Twitter account again through the legislative session, so follow us there. I have business cards, so come up and feel free to get one. I will likely be in Juneau a lot in the next 70 days, which is a good thing because that means the conversation is still on the table. And again, I appreciate your time. Thank you.